For the director's cut, November 19th. I don't know if I have any housekeeping items or anything, so I think we'll just turn it over to Lynn.
All right, well, we have a new backdrop, so we'll see how this goes. Thank you all for joining us, those who came to visit us in person as well as those who logged on. We're talking about September 2019 production. So we had made a prediction last month, I think, and a few weeks ago got asked at the Western Dakota Energy Association meeting how bad September was going to be. And I think we were anticipating maybe as much as a 7.5% drop in production, but fortunately that didn't happen. I think the best way to describe September is soggy. It was a very soggy month. It started out with almost 2 weeks of continuous rain, and as a result, a lot of road closures. So there were days when we were getting reports of 50,000 barrels a day shut in. One day, I think it was 84,000 barrels a day that was shut in. But industry was able to work through a lot of that, working with the county road superintendents. And so at the end of the day, at the end of the month, it looked like about 40,000 barrels a day production average over the month of September. The final number came in 37,000 barrels a day under. So overall, on a day-to-day basis, it was at least 40,000 barrels a day that was shut in due to the rain events. Now, as we move into October, just a little bit of prediction. I think the numbers are going to be better. We may even set a new record in October, but we have to recall that winter came to us in October. So October had a lot of cold and snowy weather. We'll see how that turns out. But I think based on daily nominations to the gas pipelines, it looks like October will be back to August numbers or maybe a bit above. So, but September was very soggy, and so we did see a 2.5% drop in oil production. We also saw almost the same amount of drop in natural gas production, down 67 million a day, 2.2%, and we saw an improvement August to September in oil prices, but that didn't hold. We saw those retract again in October, but it looks like today we're back in that same range of $50 to $52 a barrel net at the well site in North Dakota. We've kind of revamped our report a little bit just to kind of track revenue forecast numbers so people could compare actuals to what the state is looking at in terms of revenue forecasts. So we were above forecast for oil production, and for September, oil prices above revenue forecast. So those are both positives. Permitting continued on a pretty normal pace, and I think recently we've seen that slow down as we approach the holidays and freeze up. Rig count has dropped, and we've been predicting that ever since mid-year, as companies started to report that it was getting hard to raise capital and that oil prices were not supporting really growth, but that investors are looking for a return on their investment. And so that time, a few years ago, when it was growth at any cost, that no longer exists. So we saw as capital got more expensive and harder to come by, drilling rig count has dropped. And I think that's a significant factor that we have to take into account. Last week, one of our major operators was in town, and they talked about that, the fact that the private capital funds are not funding growth, and the stock market is not funding growth. They're looking for a return on investment. So stockholders are looking for stock buybacks or dividends or improvement in the stock price. So they want our North Dakota companies to operate within their cash flow. And so that, in order to do that with realized prices in the low 50s, they've got to slow activity down a bit. I don't think we're looking at a major slowdown, but we saw the rig count drop from the low 60s to the mid to upper 50s. The one startling number in our monthly report here, and the one that I really need to dig into because I just tripped it yesterday, was the very large increase in inactive wells. It increased over 400 wells, and I don't know if that is a function of the road closures and the inability to move. It looked like a large number of those were saltwater disposal wells. So it may have been saltwater disposal wells that were shut down pretty much the entire month because of road closures. But we'll be looking into that. That is not a number that we want to see increase, is inactive wells. That does not bode well for the future. In terms of well completions, we stayed above revenue forecast numbers. Interestingly enough, once again, Fort Berthold moved in the opposite direction. Actually gained a drilling rig, increased production 9,000 barrels a day, and reduced the number of wells waiting on completion. And so it moved in the opposite direction, and I think we see that then showing up in the gas capture numbers. Good news on that front, gas capture ticked up again, 1%. We're still not at 88, but we met in the last month with 2 or 3 of the major gas gathering companies. Their projects are on track to come on in December or January to relieve this situation. So we've begun the process of reviewing our gas capture policy and what that needs to look like in 2020 as we approach the requirement of 91% capture, and what kind of changes in the exemptions or variances need to take place in order to motivate industry to work with the midstreamers and capture that gas. Encouraging that we got to 83% on our Bakken production, but we continue to see that differential between non-reservation lands and Fort Berthold lands of 3 to 5%. So that continues to be a drag on our ability to get to those statewide capture numbers. And we had an encouraging meeting with some BLM officials from Washington on deference to North Dakota on regulating gas capture, but we haven't had a breakthrough, so to speak, on our negotiation with regards to the MOU that we were working on. So we're waiting for the dysfunction of Washington, D.C. to allow that meeting to flow through and maybe the bureaucracy to begin to see things more our way. So overall, a positive report from the standpoint that the very soggy beginning of the month of September didn't result in nearly the production drop that it could have, probably a third of what we expected in a worst case scenario. And oil prices appear to be holding. Natural gas capture is improving, and our only real concern coming out of the month of September is, do we have too rapid an increase in our inactive wells? So we'll be watching that one close. Questions?
Your theory on the inactive wells, it could be because of the soggy conditions and road closures, but are there other factors that might be at play here?
Yeah, so the question was, are there other factors that might be causing inactive well count to increase? And I didn't mention it, but road closures affect a lot of things. Saltwater movement is one of them. Pipeline construction is another. Workover rigs can't move when the gravel roads are too wet. They are one of the heaviest loads that has to move around. Coiled tubing units for completions, all of that equipment is extremely heavy. And so completion numbers fall, well repairs fall, and all of that. But we have been getting some indication from our operators that the marginal wells are struggling to make a profit at these oil prices. And so it's entirely possible that as we're approaching winter, people are shutting in or inactivating marginal wells, especially as winter approaches, with the wet weather and then the snow in October. I think October will tell us a lot about that. But that would be the alternative, would be, I thought of one more. And that is, we just got word this last month that the midstream companies are moving away from gathering sour natural gas. A lot of our traditional natural gas contains hydrogen sulfide, and some of those systems are being abandoned and wells are being disconnected. And we in fact have some cases coming up on the docket as a result of that. And that would result in conventional wells being shut in until that can be resolved, either through Industrial Commission relief to allow that gas to be flared, or some type of well site processing. So, there's several factors at play here. It'll sort itself out over the next month or two.
When you talk about marginal wells, are those just wells that are right on the margin of being profitable in the Bakken?
Yeah, thank you. So the question was, what do we mean by marginal wells? And so we've been told by industry that a Bakken well needs to produce more than 10 barrels of oil a day in order to be profitable. And some of our conventional wells that produce a lot of water or sour natural gas may need to produce 6, 7, 8 barrels of oil a day. So marginal wells would be ones that are in that 8 to 15 barrel of oil a day range. If something breaks on those wells, it sometimes can take a year before the well gets put back on production. Sometimes it takes a letter from the regulators to get the well back on production, and the threat of requiring a single well bond. So those wells that are producing less than 15 barrels a day, there's a tendency, if something breaks or they go down for some reason, to take a lot of time before putting them back on production. So that's what we mean. Anything under 15 a day would fall into that category.
Okay. And then go ahead.
Go ahead, I was just keep going.
Well, it's on a related subject. Can you talk about why the significant increase in the number of inactive wells is concerning?
Yeah, absolutely. So why are we concerned about the increase in the number of inactive wells? A lot of states, in fact, when we hosted Interstate Oil and Gas Compact Commission here in August, nearly every state reported that they are underfunded for dealing with orphaned wells. So inactive wells tend to turn into abandoned wells, which tend to turn into orphaned wells. And so it's the sort of the canary in the coal mine, so to speak, about what could potentially end up being a large liability for companies. And once a well has been inactive for a year and goes into abandoned status, it's very difficult to transfer it to a new operator who has the funding to put it back on production. And so it can become a liability. They also are not considered a non-compliance issue on bonds. Abandoned wells are, but inactive wells aren't. So again, we want to try to stay ahead of the curve and pick them up when we have a leading indication, like a big increase in inactive wells, as opposed to 12 months down the road when they're abandoned and we have a whole bunch of bonds that are in non-compliance in an environment where it's hard to raise capital in the first place. So, and we have several companies that we're meeting with to talk about their inactive and abandoned wells. So inactive wells tend to become abandoned wells, which tend to turn into orphans.
Along a similar line, you said the rig count is dropping. There's no capital going into investing in growth. Just last week, we were here talking about infrastructure and trying to match the upcoming increase in demand. How does the narrative of today play into that demand narrative?
Yeah, that's a great question. So the question was this narrative about infrastructure as opposed to capital not flowing to production growth. So what we've seen with the capital is that a lot of private capital funding for midstream infrastructure is overfunded. I was at a conference in Wisconsin mid-year, and the venture capital people that were there indicated that there was more capital looking for a place to invest in gas gathering and gas capture and petrochemical than there was a home for, and that some of that capital might actually be burned in the process. So the capital has shifted from exploration and production, which was the hot place to go. That's high risk, high rate of return capital. Those investors have shifted their interest to lower risk, lower return investments like gas gathering, like infrastructure, like saltwater disposal, like petrochemical. So the capital hasn't entirely gone away from the industry, but it has completely shifted the industry sector that it wants to be invested in.
And can you talk about, I'm not a finance journalist, so these terms sometimes confuse me, but like why is E&P, like why would that be higher risk compared to more of the midstream area?
Yeah, so the question was, why is E&P higher risk than midstream or some of those other areas? E&P capital is entirely tied to the initial productivity and the oil price when that well comes on production. And as we know, those two things are really volatile. So there's been, even though on the average there's been year after year continuous improvement in oil well initial production rates, there are still failures. There still are a significant number, maybe 5% or so of the wells are complete failures or economic failures. But it's the volatility, the oil prices in that sector that really makes it high risk. Will you get your capital back? If you were counting on a 20% return on investment and oil price drops $5, you will not get the return on investment that you planned on. On the other hand, the midstreamers, saltwater or produced water volumes tend to grow over time. They're always high and they tend to grow, as well as when you have 18% of the natural gas being flared, you've got a absolutely known quantity to invest in out there. And so the risk is much, much lower when you're building pipes to transport either the waste products away from the producing wells or the natural gas to a processing plant. So they're dealing with much more stable, known quantities and lower stable prices, whereas the E&P guys, they're subject to, can I get a frac crew? Did I drill out a zone? And whoops, did the oil price drop $5? All of a sudden, my anticipated return on investment is vaporized. So.
Go ahead.
I was going to say, just to clarify one thing for me. You talked about the H2s in the gas. That's from conventional wells. Bakken Gas does not have the H2s factor.
Yeah, so the question was Bakken Gas and the H2s factor. That is an interesting phenomenon, too. We have seen an increasing number of wells, Bakken wells, that have too much H2S. So the system that's been built since 2006 to process Bakken gas will only tolerate about 4 parts per million of hydrogen sulfide, which is extremely low. As companies were experimenting with larger and larger hydraulic fracturing treatments, they started sometimes fracking out of zone into neighboring formations that have hydrogen sulfide in them, one of the risks of the E&P world. And so we've got, I think on the docket this week, something like 45 cases where people are asking for flaring exemptions because they have too much hydrogen sulfide to get into a gathering system. So it's a significant issue that as regulators we're working on. One of the projects that the EERC has worked on for the Bakken optimization group is where's this hydrogen sulfide coming from, what's causing it, and what can we do about it? Now, the report that they generated for the partners is partners only for the next few months, but it will eventually be released to us as the state and the citizens of the state. So we'll get a better picture in a few months. But it's not just an issue for the legacy wells. We have seen an increasing number of E&P companies try some not really great things with hydraulic fracturing and end up with hydrogen sulfide in their wells. So.
Is there any update on the Washington crude by rail status?
Crickets. So we filed, yeah, cue the crickets. The Industrial Commission filed its response to comments, and we've heard absolutely nothing from PHMSA. So they have until April 20th. The Washington legislation doesn't really trigger and kick in until January. So we're really hoping that this month or next month we'll get a decision out of those guys. But they do have till April 20th. And again, it might speak to the dysfunction in Washington, D.C., the inability to concentrate on anything or everything. But no, not a word other than our response to comments went in and was received and acknowledged. So, and I think you'll see in Justin's numbers that rail transportation's down a bit. Yeah, and I don't know if I think that's partially the cause. I mean, we did have an announcement from some of the Washington state refiners that they were reducing rail unloading this quarter. So.
I got one more for you. Can you talk about how this actually works on the ground at a well site? If you were going to temporarily shut in a well, like what has to happen to shut in that well, and then what has to happen to make it producing again?
Mm-hmm. So the question was, what has to happen to temporarily shut in a well, and then what do you have to do to put it back on production? And it sort of depends on the time frame, but if it's a short-term shut-in, like I'm just going to shut it in for the winter, the power gets disconnected, the tanks, hopefully, according to our regulations, get emptied, so the oil gets hauled away and sold, and the salt water gets hauled away to be disposed so that there isn't a danger of a tank leak. The dikes have to be inspected to make sure that if something happens over the shut-in period, that spilled fluids don't get off the location. And then the wellhead gets inspected and everything gets tightened up. There's a thing on the top of the wellhead typically called a stuffing box. That gets tightened down so that the rods can't move and everything is sealed up. The casing valves get shut in and pressure gauges get installed. If it rolls over into abandoned status, then the commission starts requiring that pressure gauges be put on casing strings and some things like that. If people are going to leave it in temporary abandoned status, the casing has to be tested to make sure there's no leaks, and gauges have to be installed so the well can be monitored. But for a short-term shut-in, you empty the tanks, disconnect the power, inspect the dikes, and tighten everything up on the wellhead and wait for spring.
And is that what happened, like during the month of September, we saw a lot of, like, all of that happening? But like, if it's just a short-term thing, like, well, can a well be shut in for just a couple weeks?
Yes, they can. Now, if it's that short term, they likely won't empty the tanks. And if it's being driven by road closures, they can't. Yeah. So, so that's one of the issues there. The wells still have to be checked on a regular basis by a company employee, and they will be inspected by the Industrial Commission on a weekly or quarterly schedule, even if they're just shut in.
At what point then do you have to go in and claim the well?
So North Dakota's laws allow the well to stay inactive for 12 months, and then it triggers what's called abandoned status. Once that's triggered, you have 6 months to put it back on production, plug it, or post a single well bond to cover the ultimate reclamation. And once that's in place, you have another 6 months before. So it's actually 2 years, from the time that you, as an operator, determines I'm not going to produce this well anymore. They have 2 years before they have to plug the well. And then once it's plugged, there's another year to reclaim it. So the site doesn't get back to pre-production for 3 years if a well goes inactive. And then even after the reclamation takes place, it may take some time for vegetation to reestablish. But that total time frame from the decision to go inactive to actually doing the reclamation can be 3 years. Thanks, everyone.